So look, it's tough to be the last panel of the day, but then we have a fantastic panel. So I'm pretty sure the idea is that we're going to move quickly through 2-3 questions and hopefully keep your attention before we open it up for Q&A from the floor. And we have a great combination of developers, project development financiers, and of course Angela from the Africa Development Bank. So you'll get a different perspectives on some of these issues. Rather than me talking about project development finance, I thought the best way would be to start with James Leyland, who's a technical advisor of the Private Infrastructure Development Group. Pidge had at some point done a study of what's working well and what's not working so well in project development. And maybe you can start off by just giving us a bit of a summary of what that study came up with.
Thanks for that introduction, and good afternoon, everybody. I work for the Private Infrastructure Development Group, and I run something called the Technical Assistance Facility. And for those of you who don't know, Pidge is an association, I think is an association of 8 donors now, and they've set up a number of companies that develop and invest in infrastructure projects, primarily in Africa, but also to some extent in Asia. And we've done a whole series of studies over the last 12, 13 years on the role of donor money, DFI money, in the development of projects. I was actually just reflecting today that 12, 13, 14 years ago when Pidge was really getting started, this kind of a meeting probably wouldn't have taken place because in those days the concern was that there wasn't enough investment capital for projects in Africa. And the discussions in those days were all around how do we generate more money for investment. That must be the problem. We're not getting infrastructure projects done. It must be because we don't have investment money. And in 2005, after the Gleneagles Summit, the Infrastructure Consortium for Africa was set up to discuss these kinds of issues. And I remember vividly the first couple of meetings of the consortium. We had African officials kind of on one side, the G8 and the World Bank on the other side. And the discussion in those meetings was kind of dominated by an ongoing disagreement about why the World Bank and why the private sector and why the donors were not funding more of the priority infrastructure projects that had been identified by national governments, the regional economic communities, and the AU, and so forth. And the discussion always went the same way. The government officials always said, how come you're not investing in our projects? It must be something wrong. The private sector is not helping. The World Bank is not helping. We're not getting the investment we need. And the World Bank people usually led the response, and it always went something like this. These are not projects yet. These are not projects that have been developed to the point where it's clear that they're going to be bankable projects. So not only can the private sector not yet invest in these things, but the World Bank can't do that either. We've got to spend money now to get these projects prepared. And I sort of remember that as a kind of turning point where everybody began to focus on the need for project preparation. The need to spend money on a project well before it reaches financial close to demonstrate that it's a bankable project. And beginning in about 2003, 2004, everybody began to start focusing on preparation. And we realized that it wasn't the lack of investment finance, it was the lack of bankable projects. There was, in effect, a project preparation gap in Africa that was holding back investment. And it didn't take long for everybody to kind of focus on this. And I think beginning at about that time, the DFIs and donors began to think about putting a lot more money into preparation. It was clear that the private sector wouldn't be able to pay for that preparation. It was just too expensive. The projects were complicated. There was a lack of information that could be used in doing feasibility studies. A lot of the projects required upstream preparation in terms of legal and regulatory reforms. Private sector wasn't going to pay for that either. And a lot of expertise was required. Anyway, the bottom line was everybody began to realize that project preparation was a lot more expensive than we thought in the early 2000s. I remember reading in 2001 or 2002 an article about how project preparation was supposed to cost 2 or 3% of the investment value of a project. Well, the last time I looked at some of the board meeting documents of the African Development Bank a few years ago, they were talking about preparation costs of over 15% of capital investment for typical infrastructure projects in Africa. So anyway, the good news was that the DFIs, the donors, the multilaterals started to try to find money for project preparation. They all started to move upstream and recognize a responsibility to find money to pay for this because it just couldn't be financed by the private sector, by the governments involved. I think, if I remember correctly, a study in 2012 identified something like 67 facilities or funds that purported to have money available for project preparation for infrastructure projects in Africa. 67 funds or facilities, including, some of the ones that we're all familiar with, including InfraVentures and PIAF and some of the PIDGE facilities and so forth, lots of others. All of that's the good news. I think it's good news that the DFIs and donors have decided over the last 10 years to spend more money on preparation. I think that's needed. The bad news is, where are the 67 facilities? Because they're not here, right? There are a few here, a handful here. But that same study I mentioned found that only about 8 or 9 of these facilities actually did anything, actually had any money to spend, that actually took risks on project preparation. Most of the facilities didn't have a lot of money. Most of them refused to work very far upstream. Most of them worked only on publicly initiated projects, so they only worked with the public sector. They never worked with the private sector. And InfraVentures, of course, is an exception to that, but one of the few. So, what we have is a gigantic network of DFI and donor-funded preparation facilities, and there's a lot of money in that network, but the individual facilities, none of them have very much to spend. And none of them really work together because of differences in business plans and different approaches and different sets of bureaucratic rules. So I would suggest, I think it's not me I'm not the only one suggesting this, but one of the problems we have is this fragmented network of preparation facilities. It's hard to find them, it's hard to access their money, it's hard to do what they want done. And somehow that network has got to be rationalized. And this is something that has been recommended pretty frequently over the last 4 or 5 years. It would help if the donors could rationalize this network, get rid of the smaller facilities, put more money into 1 or 2 facilities or 3 facilities, and just try to get this whole program moving in the right direction. Now, having said that, Africa 50 is definitely a step in that direction. That's one of the things I think that was behind setting up Africa 50. The World Bank's Global Infrastructure Facility is another example of trying to scale up preparation activities. And Power Africa probably fits into that category as well. So there's some initiatives being taken, but we're still burdened with this huge, complex network that is just not being very productive. So on the one hand, I think the DFIs and donors have the right attitude. They're doing the right thing, and they support my facility, the work that I do in the PIDGE group, and I'm grateful for that. But I think there's a lot more that has to be done to kind of scale this up and make it really work for the private sector especially. Sorry, that's probably enough from me.
James, thanks. No, that was great, because you not only did a bit of a diagnostics of what's going on the project preparation side, but you also started moving into sort of the future. Where do we go from here? Which is fantastic. But I wanted to just bring in a few other perspectives to this. And Raymond Carlson, CEO of Scatec Solar, operates in the sector globally. Raymond, so James spoke about project preparation, funding, all the way to project development. When you are engaging on a project, at what point, I'm sure you're starting to think of how to find partners along the way, how to bring financiers into it. At what point do you start thinking about partners and financing for project development? And also, since you operate globally, talk a little bit about what you see different and similar in Africa that you see in the rest of the world as well.
Thank you very much. If you take a look at our pipeline, backlog and opportunity list right now, it's about 3.5 gigawatt, so it's substantial. The way that we categorize the project is that we charge all the development expenses to the P&L until it's a 50% probability of this actually being a real project. After that, the expenses, and they increase substantially up to 50%, will be charged to the balance sheet. Of course, if we do not succeed, it's a loss. And we're a listed company and are having this quarterly nightmare where people are wondering why one of our values is being predictable. So for us, it's important to involve the development banks at the very early stage. In the early days, we were faring very well with the type of experience we didn't have. I mean, understanding governments, understanding why things take time, helping us more or to focus directly on what we need to resolve. But even with that, things take longer than anticipated. I said this morning that we decided not to stay in Namibia. There are several of the other countries that has been mentioned today that are suffering, I think, from the same thing, and that is the procurement programs are not mature. They don't know how to put things together in a bankable fashion. And they're also, and I think that includes to a certain extent, the whole industry, they are being polluted by the extreme reduction in cost from solar. So everybody's like the computer industry. You wait 1 year and your computer will be twice as fast, right? But of course, you're not helping the economy. You're not helping anybody by waiting. What we think is extremely important is to actually create predictability in the way that the authorities are handling these procurement programs. I think the DFI can help doing that. If there are any differences between where we operate in, for example, Honduras or elsewhere in Central America, South Asia, Africa, I don't think so. I mean, these emerging economies have a few challenges, and I think you see similarities, both on the negative side, but also on the positive side. I think that project finance and the way that deals are put together is being more and more copycatted from one project to the other. I like to commend South Africa. I've done that many times before. My biggest worry was that this REIPP program wouldn't take off. And I was so worried that I decided to move here to be sitting next to the process. So I stayed there for a couple of years, and after we were successful as well, to make sure that we delivered according to what we had promised. If this first round hadn't happened, South Africa would not have enjoyed the drop in price from 25 US cents or 2-3 rand per kilowatt hour down to our round 4 price of 0.7 rand. And I'm happy to report to you that even at that level, we're making 15% on after tax on the sale of electricity and also on construction. So should everybody be expecting 5 US cents? No. You should expect a much higher price initially. And then, once you have established the behavior and how you deal with the complex issues, you will benefit in the longer term. And as a digression, I mean, it's kind of interesting to look at this 0.79 rand per kilowatt hour. Incidentally, is identical to the cost of distribution in Norway. you can't beat that, because if production of electricity becomes cheaper than distribution, you don't distribute. So this is what we will see over the next 5 to 10 years. But I would love to have, our partners share more of the cost that we have to charge of our P&L. I think we can develop much, much more rapidly than what we have done in the past. And I have to say that we have been fairly successful. I mean, we haven't had to write off a lot of projects. And that's thanks to, I think, our partners and the way that we're actually running our business.
Thanks. Thanks, Raymond. Brian Herlihy, CEO of Black Rhino. You are focusing on large projects, which makes you relatively unique, on this panel. And we heard this morning about the costs, the development costs involved in, for example, Azura, which was one of the large projects that the continent has seen. How do you go about putting together your partnerships and your financing for developing such large projects, and what are some of your thoughts that you would like to share with other developers?
Sure. Thank you. I think we discussed earlier, our shareholders force us to a fairly strict ratio of development dollars to investment dollars. So we judge the milestones that we achieve and the amount of risk capital we can spend before achieving those milestones. And if we don't achieve it, it becomes a cliff. We can continue on the project, but we effectively have to freeze spending. We limit it to travel and internal corporate overhead. So that really forces us to walk away from projects sometimes when we can't achieve what's being required. So we've really been searching and engaging with some of the project prep facilities. To us, those are becoming very important because sometimes we can't, not sometimes, a lot of times we can't achieve the milestones and the budgets that we have. So for instance, we're working in Ethiopia with the Development Bank of Southern Africa, and that's been able to expand sort of the horizon of what we've been able to do. And that's been important. This is a regional project, Djibouti and Ethiopia, and there's complexities beyond just the project itself with the cross defaults and the like, and the capacity building in the countries. So to us, the project prep facilities are very welcomed. We probably haven't done enough to understand who the whole 67 project prep facilities are, but I'm sure if my boss heard that there were 67, he'll get me out there looking. But I think the question of where can DFIs come into this earlier. At the end of the day, I said this morning, they are complex projects, but they're not rocket science. The negotiations about allocating the risk. And as countries mature, they would like to see more market risk pushed onto the investor. And as the investor comes into these markets, they're looking for the government to take more risk. I do think there is a role for the DFIs to have a less boxy structure on how the project finance works, and that will require getting involved much earlier, and looking at it. And look, you're seeing it. I think if we just look at the last, sort of 10 years in Africa, right? You had almost a project finance only world. In 2005, and then that changed with the onslaught of Chinese bilateral financing. And I would say by like 2011, I actually thought my job was extinct. I just didn't think project finance was going to work anymore because the bilateral financing was just easier for the governments. And if I were in their shoes, I would take it too. But then the debt levels started creeping up again, and you started seeing ratios of 30% to GDP, and project finance started coming back into the fold. But and that brought back the traditional DFI structures. I'm hoping as an investor and a developer, you start to see pressure from the different global DFIs that make people relook at the risk allocation and have DFIs take some greater risk, particularly as countries go through the evolution of building up system operators or strong balance sheet utilities. But that's an iterative process that involves a lot of dialogue back and forth, and we're developing a project on the heels of Azura, and we're really benefiting from that. And the question the Nigerians will ask is, yes, we took this for Azura, but do we have to take it again? What reward do we get for the second project and the third project? So those are conversations that need to happen earlier as opposed to later.
Thanks, Brian. Angela, I'll come back to you so that you can bring in the DFI perspective after all the developers have given their perspectives. Reginald Max, he's the originations leader, development and investment for GE Africa. Reginald, you were telling us that you see basically everything that comes to GE in terms of projects on the continent. And from your shoes, give us some perspectives on your experiences of working with financiers and partners on the project development side, and give us some war stories of what you've appreciated and what has been some of the things that you'd like to see differently done.
Maybe I should start by saying GE is not a donor, neither is it a DFI. So I think my perspective is slightly different in that we have a relatively selfish kind of attitude to project development. Obviously, we're doing it for the purposes of creating our footprint in Africa. So GE traditionally was an OEM. We supplied equipment. And I think we realized over time that we needed to pivot and start looking at the project development aspect, especially in sub-Saharan Africa, as a way of doing two things. I think firstly, to support governments in their ability and in their understanding of how project development works, and secondly, to also increase our footprint. What's key in my mind is one of bankability, and I think it was mentioned by James earlier that the whole development process, project development process, is really to identify project bankability and how one achieves that. So one may look at it from an early phase perspective, and let me tell you what I mean. You talk to different developers who will tell you, we come at an early stage and this is what we want to do. So the minute you start conceptualizing a project, we want to be part of it. Some will say, we'll come in at the pre-PPA project phase, and I'm talking here to power. So just before you sign the PPA, we'll come on board and we'll support you with whatever resources are required to be able to make it happen. And in some cases, some don't even come until after the PPA. So you'll find in the whole project development arena, what we've discovered as GE is that there's lots of dependencies, and the dependencies are around regulatory framework, around technology mix, around access to gas. And I say that with Nigeria in mind, in that when one looks at developing a project today in Nigeria, especially power, one's got to understand where the gas is coming from and where the transmission will be to evacuate the power once you've developed it. So you're not just looking at the project in isolation. You've got to look at the full value chain of infrastructure and what it means to be able to take it forward. So we spend a lot of time advocating and talking to national governments to make them understand that the power sector, for example, is about feedstock, identifying where gas is and putting the pipelines in place, generating it, and then evacuating it. And going back 10, 15 years, the Nigerian government put up, I think, something like 5,000 megawatts, which today is still stranded because there's no gas. Now, it doesn't happen anywhere else, but it did happen. And even if they did find the gas, they wouldn't be able to evacuate it because there's no transmission for such capacity. So again, herein lies the big issue for us as GE is not just looking at project development in ensuring that projects get to bankability, but making people understand the full value chain of that infrastructure play going forward. So, and again, I think going back to what I do, so at least I just explained that when someone said I onboard projects, my responsibility at GE is to look at every single project that is brought by our customers or by potential developers who are looking to put together power, transportation, rail, or whatever it is that GE has a vested interest in. We assess that almost like venture capitalists, and we determine bankability. And that determination is primarily around 7 or 8 different principles, and you may have 1 to 4 and may not have 5 to 7. Or you may have 1 to 3 and you may have 7 but not have 5 to 6. And we then make a determination whether we believe that it's bankable and it's feasible. But we've taken a slightly different perspective to this in that we realize that looking at projects in isolation doesn't solve the problem. And let me explain. I'll use Eskom in South Africa as an example. And then I'll extrapolate that to other utilities and other agencies with a similar mandate in different countries, is that we know that Eskom needs to deliver another 10 gig into the network over the next 10, 15 years. We know that. So our play is let's partner for the next 10, 15, 20 years. So we're no longer partnering on a project-by-project basis, but rather looking at the full value chain and saying we're part of the process over the 20-year period, and we'll inject capital year on year to ensure that as you roll out your build program and as you develop the project, we're part of the process to make it happen. What it does, it allows you to have a consistent approach to project development. It obviously allows you to buy GE equipment, which is great for us. But principally what it does, it then allows and provides a consistent approach to infrastructure development, not project development as such, because we then look at the full value chain and what it means to invest in the different components of it. And we invest in that process, and obviously over the next 15, 20 years, we benefit from it. But then it becomes a win-win situation. Because the minute you start looking at a project in isolation, you're hamstrung by regulatory frameworks, hamstrung by multiple funders asking for different covenants in the agreements and so forth and so on. So that's really what I'm looking at. So my call to action would be to the DFIs and to other developers that let's look at a long-term play. Let's identify agencies in sub-Saharan Africa who have a long-term mandate to deliver. We know it will happen. It has to happen. If you look at Nigeria, for example, they have a particularly serious energy situation, but we are aware of the fact that in the next 15, 20 years, they're going to put something on the grid. They're going to have to develop. So let's be part of that process and let's make sure that it works. So we then develop teams that understand different parts of that value chain, so we allow the national governments and the agencies to be able to do that. And we say that, again, if you look at sub-Saharan Africa today, it's depressed prices, volatility, exchange rate issues, no foreign currency. So you find that you have to ask yourself, do you stop until they get back on track? So do we wait until Angola gets back on track? Do we wait until oil prices are back up again and the commodity price boom starts kicking in? And the answer is no. The answer is it's a long-term solution. And that's really where what we see, and our philosophy is really just driving that relationship to ensure that we meet those objectives. And where we interface with DFIs and other players who come in as co-developers on specific parts of that value chain, we're happy to interact to ensure that we meet the objective of delivering on the ground.
Great. Thanks, Reg. So, Angela, we've heard, I think, from our colleagues here, a number of different areas where the DFIs could actually come and play an interesting role in preparation, development, and then finally in financing. From the perspective of a DFI, what would be your suggestions for developers? How do they best engage with the DFI community? At what point of the cycle? In what sort of role do they bring in a DFI? What have been some of the things that you have seen that has worked well and others that have not? And finally, also then help set the stage for the Q&A by telling us a little bit of what the DFI community is looking at in terms of project development finance and where we go from where we are.
Thanks. Reg, I think what you just said is really music to my ears. DFIs, of course, take a long-term perspective of all the African countries, and we look at the full value chain of infrastructure development. I think my advice to any developer is that you engage the DFIs as early as possible for these reasons. Number one, DFIs have a lot of the local knowledge and experience in these countries, and they can bring it to bear, advise you on how best to approach different government stakeholders. Secondly, DFIs put in the time to build local capacity. The African Development Bank, for instance, is set up with other donors, the Africa Legal Support Facility. I think many of you have had this experience. We have set it up so that we can empower the governments, so that you have a worthy counterparty to negotiate with. Not only do we build their skills, impart them with some confidence, but we also try and make sure they have world-class legal representation. I think that has helped in a lot of transactions, and we have many more and more governments taking up this offer. Number 3, we do help in shaping policy and regulatory reform, obviously due to our long-term perspective. I think we have IFC Advisory that has been doing it for a while. The African Development Bank as well, under the new president, is going to set up to work very closely with partners, most especially the World Bank and Power Africa in this space. Later on, I'll talk about what concretely we're doing as the African Development Bank. And then last but no means least, we do also dabble into the risk capital space. African Development Bank a few years ago set up Africa 50. I think we decided to put our money where our mouth was to address the dearth of bankable projects. So yeah, for project developers, I think it's most advisable that you get the development fund institutions involved at a very early stage. Now, what hasn't worked well? I think we need to do more about the project development vehicles. The 67 or so project development vehicles, I think at least someone counted them. A few years ago, we didn't know how many. So I think the next step is for us to get together under the African Development Bank's New Deal on Energy, especially in the power sector, to see how we can bring all partners together. It's a strategic partnership that we're trying to build to make life easier for all those who are trying to bring capital into Africa. What has worked well? I think we've all increased our budgets towards African infrastructure, and I think we have a lot more interest in private sector in developing projects in Africa. So with that in mind, I'd like to say that, yes, infrastructure is a good asset class, especially African infrastructure. Maybe I'm preaching to the converted, but I don't think you can find the returns you find in Africa anywhere else. I think that's why many of you are still in Africa, despite the frustration. And there's a lot of low-hanging fruits, and you have partners that are ready to hold your hand.
Thank you, Angela. So clearly, through the day, we've been through several different parts of the project development chain. We're at the point of discussing, okay, so what are the financing availability, for project development? We've also identified some weaknesses currently in the framework, but we've also come up with some ideas in terms of how to go forward with the help of the development finance institutions. And also there are other partners that are starting to play into Africa. It's fantastic, just to see this group convened for African project development and infrastructure is something that we would not have seen a few years ago, and that itself shows the interest here. With that, let me open it up to the floor, because I'm sure there are many questions about, for the panel about what we could do even better on the financing side. So please feel free to raise your hand, and hopefully we'll get you a mic. Yeah, Alain is going to start us off.
Yeah, I'd like to do that, but just in case, to be speaker. My name is Alain. Somebody doesn't want me to speak.
We can hear you, Alain.
Yeah, okay. Let me see. Maybe I don't need a mic. Better no? Okay, it's working. So my name is Alain Ebobisse, and I'm the global head for IFC InfraVentures and the lead sponsor for this event. And again, I'm very happy to be here. But one question that I had, in fact, I'd like to pose the question to either Raymond, Brian, and you, Regional, I think, from GE. So we welcome the entry of players, EPC contractors, equipment manufacturers into the project development cycle as developers, because I guess the more the merrier. But there's some tensions between developers and EPC contractors or equipment suppliers in the development process. I guess developers like to have the ability to run competitive bidding processes to select the EPC. But at the same time, there's value from the EPC guys to come in the earlier stage. So I'd like to understand the dynamic. What do you prefer? Do you prefer to go it alone and develop the project and later select an EPC contractor, or would you, partner from the get-go with an EPC contractor? And what are the pluses and minuses? Raymond seems to want to start.
Well, I think if you take a look at our model, we include everything. So that means that you're going to see me or some of my colleagues on every side of the table. So we develop, we build, we operate, and then we are also the co-investor. So some people may say, I guess you guys are taking us for a ride now, huh? We have to be extremely careful and transparent at all stages, and when issues are being dealt with that is conflicting, then we leave the room. We have done that a few times. So once people get over the experience of the model, where it works, and it has worked most of the time, they come back. And that allows us, when we're looking at an opportunity, to do we call it a global IRR calculation, where we look at the returns of all the stakeholders. And we can maneuver a bit in between the various developer fee, for example, EPC margin, or the IRR that you get from selling the electricity. The advantage of that is that you reduce the number of stakeholders, you standardize on the contracts, and you can mitigate any aspects, and I'm telling you, they happen all the time, while you're at it, before and moving towards financial close. As a reference, and it's not that bad everywhere, but in our first project in South Africa, we had 150 legal agreements. We were the largest customer of the largest law firm in this country. Crazy, isn't it? So we need to standardize, and there is no reason, when you look down the road, that electricity is going to cost more in Africa than elsewhere. So our model, I think, is focused on a further reduction and an increased competitiveness, so that at the end of the day, the consumers are going to enjoy the lower tariff.
Yeah, it's a tough question. Look, I think solar is a different business because I think the construction is a bit more straightforward. At the end of the day, I can define an EPC contract. My contractor friends can define an EPC contract. The devil's in the detail. Having someone sit at the table with me, I like the idea. I like the early engineering input. I like the contribution. But I don't know whose contract they want to sign at the end of the day, my EPC version of a contract or their EPC version of a contract. It's difficult. We haven't done it yet. We'd like to keep the right to ensure we can negotiate what we want. But if there's only one of me, not three of me. If I'm only sitting on one side of the table in this, I need to negotiate the contract that I need. And EPC is about as devil in the detail as you get. So it's very difficult. I've had a lot of conversations with GE, for instance, and it's necessary sometimes to get the EPCs involved much earlier. Take our project in Ethiopia, which is a pipeline. I have to give a price to get my offtake contract. It's not something I can model. I need to know the geotech work. I need to know. There's so much I need to know about the route before I can go and give an actual price. So I have to bring the EPC in earlier. Now it gets into what form. Do I want them putting up, risk dollars as a equity investor? Do I want them putting up risk dollars as sort of a form of a loan, something that they recover later? Well, yeah, I have to think about that. The equity, sometimes it doesn't align us because at the end of the day, then you're really getting into the hard negotiations. So I think it's great that all the models are under consideration. And I think every project's different. I think if you're going into a power plant where it's been done before multiple times, you can look at it one way. If you're going into a pipeline where there's just external factors that you need to know, you have to look at it a different way. So, I was smiling when you asked the question because it's a great question, but not an easy answer. I think you need flexibility. I think the fact that you have the options now is terrific.
Yeah, I think I agree with Brian. I think it's a moving target in as much as we have preference for certain EPCs, and I think some EPCs have a certain preference for GE equipment. And I think the story goes on. We're currently involved in discussions presently where we're having issues with EPCs around, again, contractual issues, contribution of development dollars and what that means going forward. I don't think one can define a business model as such, when one kind of looks at partner selection and how they kind of unpack a project. I think it's really based on country, the type of sector. Is it a rail project? Is it power? And so forth and so on. And I think that really defines, who you bring in at the beginning or at the early stage, and how you work towards a pricing and delivering a more efficient tariff, if you want to say that.
We probably have time for one more question, please.
I had a question about the REI PPP specifically. So I know that Angela mentioned at the end of her remarks that one of the things that makes investment in infrastructure in Africa so attractive is that the returns continue to be high. And so I just wanted to get your thoughts as developers, what you think the sustainability of a program like the REI PPP is as returns go down along with the price of solar dropping.
Raymond, you want to take a crack at that, or Reg?
Yeah, that's a very good question. The uncertainty of the RAN hasn't changed really. The status of the financing in this country hasn't really improved. Hopefully that will happen. You see different players coming in that are playing balance sheet, the balance sheet game, which is perfectly okay. I think in round 4C now you have reached a level where you may see that some of these projects are not financed in terms of the useful project financing. Whether that is going to stop the program in its current nature, I don't know. That could very well happen. So I'm very curious about South Africa. I think as I said before, the country has benefited greatly, and if they can keep up with the infrastructure development as well, it's going to be fantastic. And once the battery factories that are popping up all around the world are going to shave off the peak production and take out its extremely expensive 35% of the installed capacity worldwide, but also big capacity here, you will see a different situation. And you don't really need the lowest tariff. You need predictable players that can actually support the overall programs. But we are at the stepping stone of something extremely interesting. And this country and a lot of African countries are going to benefit from that.
I think you bring up an interesting point. I think it's a debate and a discussion that happens in offices across South Africa today is how low does the tariff go? And again, my view is very simple. The market will find a way. That's what the markets do. Markets will work it. You'll get to a point where your tariff will become unsustainable, and you'll pay the price for that. So I think really the markets will find a way. It will bottom out, and it might even go up. And it might slightly go up because of currency issues, because of political risk and other factors. But I don't see a continued and sustained decline in a proposed tariff on the reprocess, and really that's just how markets work. and I think it is sustainable, and this is exactly how markets should behave, and again, the way markets will react, and I'm not in any way predicting what the future will look like. Some of us will still be there, and some of us won't be there, but that's exactly what it is. But it ends up being a better market with a properly, reliably priced tariff.
Thanks, Reg. So James and Angela, I'm going to, sort of the last question, I'm going to take the option of asking the question myself, which is, James, you mentioned, better coordination among the various project preparation facilities when you were talking about the 67. And Angela, this morning we heard about the multiplicity of financiers for projects on the continent. I think, if I'm not mistaken, Azura had something like 19 financiers. And of course, all the challenges of coordinating among those financiers. What are we doing in the DFI community? What do you see happening that leads to better coordination and helping the developers in terms of negotiations with one voice and with common terms? Do you see anything happening? And if not, what can we do?
Well, there's definitely some things happening. For one thing, the ICA Secretariat, the Infrastructure Consortium for Africa, the secretariat that's in AFDB has set up a network of project preparation facilities. And they're trying to get everybody to come to meetings and cooperate and collaborate. And it's just getting off the ground now, but I think it's showing some promise. And I also think that, actually, Hubert and I were talking about this during the break. The network here of private project developers could also benefit from engaging with this network of DFI developers that's beginning to take shape at the AFDB. So I think people realize there's a problem. They're just not quite sure how to fix it yet, but I think we're sort of moving in that direction.
Okay, I suspect that we have a multiplicity of financiers on any one deal because we do have very few bankable projects. We still need to do a lot of work with the governments, reforms, just getting them comfortable with project finance, and also helping them with the procurement. Because I think many of them have now come to the realization that single sourcing is not sustainable for them. And I think they've also been watching South Africa and the success that South Africa has had with the renewable energy. Now, I think DFIs come into their own with the ability to lead, mandated lead arranger status. I think we're trying to do that to a certain extent with your projects in Nigeria. I don't know how it's working so far, but I think it's working well. And also, IFC and ADB have this AEB loan structure that I think IFC has been using it for a while in a number of jurisdictions, not so much in Africa though. But we hope that we can jointly start using that, so it will help a lot with the number of players you have before you on the table. So we are, as an institution, ADB is set up in a way that allows us to maximize the public and private, because we're a single institution. And we leverage different financing instruments in ways that are driven by the Africa's needs. So our core business is drawn from what the government needs. So to a large extent, that helps when we're engaging with the governments. And this has been the basis of our new strategic priorities, what we call the high fives. And I'll take, if you allow me, just 2 minutes, just for you, Sujoy. The high fives are, we're trying to look at Africa's development holistically. We have number one, and I think there'll be homework on this if anybody's not paying attention. Okay, number one is Light Up and Feed Africa, Power Africa. Number two is Feed Africa. Number three is Industrialize Africa. Number 4 is integrate Africa. And number 5 is improve the life of Africans. But in all these 5, power is really the catalyst. And power is where we're putting a lot of emphasis. The African Development Bank is going to put at your disposal about $12 billion over the next 4 years to try and bring the access levels on the continent up. So we're going to do that in a number of flagship programs, but most importantly, with strategic partners like the World Bank Group, in particular IFC in our case, and Power Africa. So you're welcome to talk to us anytime.
That's fantastic. So I'm told there's a burning question at the back of the room, and we do have time for that. So please.
Thank you. It's not a burning question. I just wanted to ask, particularly the developers, and the last summation by the lady at the end of her presentation. We have seen in the REAP process the prices going way too low. Is this now the moment for South Africa to actually go into a renewable energy feed-in tariff, which can potentially allow local developers who don't have the same balance sheet of the people that are sitting there to actually then participate in a manner that we actually then end up having local players being a player in the market? So the key question to the guys on the table, if we ended up with the refit, is it the time for it? Will you still continue to participate in the market?
And perhaps keep the answers short.
Well, I'll tell you something. When the program started, we established here in Joburg and in Cape Town. After 2 years, we decided to close our German office completely. And we are using the organization that we developed in South Africa for the whole world. The project manager on Joinberg was the project manager on our 100 megawatt project in Utah. So the program is already reaping benefits. We're also sponsoring in a 5-year program the University of Stellenbosch for technology development, using our parks as test or guinea pigs for new technology. So I think, we're not here only for South Africa. We're here, to create an opportunity that goes way beyond what South Africa has created for themselves.
I think a question on feed-in tariff. Look, there's obviously other factors that, make a market ready for feed-in tariff, not just the tariff. I think Eskom's balance sheet is probably the most pressing issue, and you have a very complicated tariff structure here that effectively has cross subsidies. So there's a big fear that feed-in tariffs will kill some of the cross subsidies of the power structure. But across Africa, you're getting a march towards actual costs. To me, feed-in, I moved here with my family. What country is better suited to solar to the home than this country? It's sunny most of the time in this part of the country, at least. I think absolutely it's a necessity, and I think you'll see it forced into play. You're starting to see a robust commercial industrial solar play. And if you start to see residential solar, which people are talking about doing for direct use, not a feed-in tariff, those are going to be your higher paying tariff people. And that will really force the conversation, because Eskom can't afford to lose those tariff payers. So I think it will happen. I don't think it will happen fast, but I think it will happen over the next few years.
Thanks for those great questions, and led to a very engaged discussion over here. So look, from my sort of takeaway from this day and from this discussion is I sort of leave in my mind with a great group of people working on project development for infrastructure in Africa. And I leave with the 3 Ps, I would say, patience, partnership, and predictability. And I suppose with that, let's give the panel a warm hand. Thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.